Hey, this is Seth, and today we're going to talk about how to crack the code on bigger land deals. So, when you've been in the land flipping business for a while, you may eventually find yourself yearning for something more, something grander, something to reignite that spark of excitement. And sure, those same old land flips are always going to bring in decent profits, but for some people, the thrill of the chase starts to fade. It's kind of like eating the same flavor of ice cream every day. It's like it's good, but eventually you're going to start to crave something different, something more satisfying. And if you're nodding along and feeling like it's time to level up and chase after those bigger, juicier deals, then you're in the right place. We're about to shake things up and change the traditional land flipping business model you've been following this whole time. We're going to explore the natural progression that many land flipping professionals go through. We're talking about seizing those high value opportunities that promise really big paydays and heart-pounding excitement. It's a whole new ball game with different rules and strategies to master. So buckle up because things are about to get interesting. As you gain experience and build your reputation in the land flipping industry, it only makes sense to start targeting more valuable properties. By shifting your focus from smaller entry-level flips, I'm talking about properties worth, less than $50,000 to larger deals with values in the $50,000 to $500,000 range, maybe even higher, you'll open the door to significantly higher profits from each transaction you do. This is going to allow you to spend less time making more money from a smaller volume of transactions. Now, most land flippers, if they're working long enough and diligently enough on this business, this is something that they will eventually figure out for themselves. But before we get too far, I want to take a minute and give credit where credit is due, because these ideas didn't really crystallize in my mind in black and white, plain and simple terms until I read The Land Investor's Playbook by Travis King. This is a beautifully written book, and in chapter 2 of his book, he describes what he calls the boss play. And the first time I went through this chapter, even though it wasn't necessarily new information, it was the first time a light bulb went off in my head and I just saw the picture painted so clearly and eloquently that I knew this information would click with a lot of people. So if you haven't picked up Travis's book, this is definitely one worth checking out. And what we're going to talk about here in this video is my take on this strategy. And a lot of the considerations I think you need to keep in mind if and when you decide to go down this path. Because for most land flippers, if they stay in this business long enough, this is eventually where they're headed. So I want to make sure that when you get there, you're doing it with a clear roadmap of how to take these next steps. Because going after these larger deals in many ways is like following a very different business model. And if you don't reframe your thinking, things just aren't going to go as well for you. It'll be like trying to fit a round peg into a oval shaped hole. It's kind of the same thing, but it's not quite the same. And you want to make sure you're pursuing a strategy that fits like a glove with the types of properties you're actually trying to go after. And when we're dealing with higher value properties like this, the first big mindset shift we have to undergo is how we make offers. We have to completely rethink this, because when we're intentionally going after properties in this higher value range, we're not going to deal nearly as much with smaller, less desirable properties with limited uses that most people just don't want. As the larger numbers imply, properties worth over $50,000 will undoubtedly be more desirable with more valuable uses than those bargain basement properties. And here's the thing. Most of these landowners are going to be well aware of the higher value. They're not going to be quite as eager to let their land go for pennies on the dollar. And while it's true, these smaller, cheaper properties can realistically be had with offers around 15 to 40% of market value, larger deals are going to require a much more aggressive approach. If you want to play ball in this league, you got to step up to the plate and start swinging like a major league hitter. In other words, you'll have to adjust your offer strategy. Now, granted, I'm not saying you'll never be able to buy higher value properties for the 15 to 40% of market value range. It can happen, and I've certainly seen it happen before, but if you adhere strictly to this model and you're only willing to offer in that range for all properties, including those higher value ones, the odds will not work out nearly as well with the higher end properties as when you're only working with the cheapest vacant lots on your market. So in order to adjust our offer strategy, we have to examine this whole debate of ROI, which stands for return on investment, versus absolute net profit. And which one matters more? So when we're talking about adjusting our offer strategy and possibly offering more than this 40% of market value range, I know what you're thinking because I used to think the same thing. But Seth, isn't this going to hurt my ROI on each deal? If I offer a much higher percentage of market value, isn't that too risky to make such high offers? Isn't that going to hurt my ROI? And I will say, when my land flipping business was in its infancy, I was utterly obsessed with my ROI, my return on investment. For every dollar I invested into a property, I wanted to see at least 2 to 3 times more coming back to me after it was sold, preferably 4 or 5 or 6 times more. I mean, I was like super conservative. I would only offer the bare minimum because whenever I got an acceptance, I wanted to know it was a grand slam deal. And that's why I militantly followed this model. I mean, I used to offer only 10 to 30% of market value, maybe as high as 40% if I felt really dangerous and was willing to go out on a limb. And when you're working in a slow, depressed market like I was back when I got started, and when you deal strictly with cheap land and you make enough offers, you can certainly find deals like this. But when we move up to the big leagues, and especially when we're in the big leagues in a hot market, when real estate values are a lot stronger, we have to change our thinking. ROI starts to matter a lot less with larger properties because really, at the end of the day, what we're most concerned about is what we call the absolute profit we're walking away with. And this goes far beyond looking at mere percentages with the ROI. Absolute profit is the raw financial gain we get from each deal. It's the difference between the total revenue generated and the total costs incurred when we buy this property and pay for all our closing costs. For instance, if you buy a property for $100,000, including all your closing costs and holding costs, and then you sell it later for $150,000, then your absolute profit would be $50,000. And ROI always matters to some degree, but it's not everything. And as we bring larger sums of money to the table going after bigger deals, looking strictly at ROI just doesn't make that much sense anymore. I'll try to illustrate why ROI matters less with a few examples. So I once did a deal that earned me a 4,900% ROI. It was an insanely high ROI. It sounds really impressive on paper. And this was based on a property that I bought for $500 and then I sold it for $25,000. And of course, it was a great deal by anyone's measurement. But what if we removed a couple of zeros from those numbers? Suppose I bought that property for $5 and I sold it for $250. That's the same 4,900% ROI, but I'm only walking away with $245. And a $245 profit is just not quite as exciting, is it? It's the same ROI, but what can you do with $245? It's just not that much to write home about. Now, on the same coin, what if we took that same ROI scenario and we added 1 or 2 zeros to the original numbers? What if the property was worth $250,000? Well, in that case, the ROI could be significantly lower and it would still make a very exciting absolute profit. I mean, if this property was truly worth 250 grand, I mean, we could pay a whopping 200 grand and sell it for that $250,000 amount, and our ROI would be much smaller at 25%, but we would still walk away with a $50,000 profit. I mean, heck, even a 15% profit on a $200,000 investment would be pretty cool. So you see, the bigger you go, the more you realize that ROI isn't everything, because what we're ultimately looking for is our absolute profit. How many dollars will we walk away with when this deal is done? There's a general trend in the land investing business where the higher ROI deals typically yield a much lower absolute profit. And by contrast, the higher profit deals are typically going to yield a much lower ROI. The two things have kind of an inverse relationship with each other. While higher ROI percentages might appear more attractive because it's a great big percentage number, they often do not generate as much of what really matters, which is the absolute profit. For lower value properties, a high ROI is more important. And for higher value properties, a high ROI is less important. So let's get more specific. What does this new offer framework look like when we're going after these higher value deals? Well, if I'm trying to buy a vacant lot that's worth $100,000, I'll have a much harder time finding motivated sellers who are going to let that kind of property go for 15 to 40% of its market value. At 40%, I might get lucky. At 15%, it's very, very difficult. Unless the property has some big obvious problems with it, like being landlocked or covered from end to end with wetlands, most landowners of larger properties just won't let their nice, desirable real estate go for such a huge discount. I'm not going to say it's impossible to find these deals. After all, I've found them before, but they're just a lot less common. You could spend a lot of time and money looking for these deals, and if you don't know when to stop, your marketing costs could even lead to a net loss in the end, even if you do find this kind of deal. So when I make offers on larger deals in a solid market where I know the property will sell quickly, and by the way, that's a very important component to this, my offers are going to start in the 40 to 60% of market value range, which gives me a much better shot at getting the deal. And I might even go higher than that, depending on the specifics of the property and how I plan to use or resell it. So in a very real way, our business model has changed dramatically here, and my offer to value looks very different. I'm not making offers like I used to when I was just going after the really cheap stuff, and my whole mindset and frame of thinking is different when I'm going after higher value properties. The profit margins as a percentage basis are definitely getting thinner here, but keep in mind, even though those percentages are getting thinner, the absolute profit is still thicker because the revised offering structure deals with much larger denominations, and the actual number of dollars we're going to walk away with at the end of the day is going to be much higher. Now, while we're on this subject, I don't want to get too far off on a tangent, but there's something else worth mentioning. Now that we're willing to offer a lot more for these higher end properties, there's also the option, if we're willing to do a little bit of extra work, to subdivide, get entitlements, or even improve some of these properties that we're acquiring. Now, if I'm buying a property that I can subdivide or get new entitlements on or make some other improvements, now in those cases, I'm thinking more about the property's future value after I make whatever improvements I'm planning to make. Think of how house flippers make offers using the 70% rule. If you're not familiar with this, what they do is they look at the ARV, or the after repair value, and they make their offer based on 70% of that number. So for example, if a house's ARV, or after repair value, is $100,000, then the 70% rule says that the investor can spend up to $70,000 to purchase the property and make any necessary repairs as long as it stays within that $70,000 limit. So if the investor estimates that the repair cost is going to be $20,000, then the rule says that their maximum allowable offer, or MAO, is $50,000, because $50,000 plus $20,000 is, you got it, $70,000. So when I look at a higher end land deal involving some improvements, I like to work somewhere between that house flipper's 70% rule and this revised 40 to 60% offer range when we're looking at bigger land deals. So again, let's say I find a vacant lot worth $100,000. And in this case, I'm not just going to buy it and sell it as is. I'm going to hire a surveyor to help me subdivide this thing, and it's going to cost me about $15,000 for that surveyor's help. But when they're done, and when I sell off these new child parcels, the total sale price of all those parcels is going to be $200,000. So twice as much as the $100,000 I paid for it. So if I'm confident that that property is truly worth $200,000 in the future after these changes or improvements are made, I could easily offer 70 to 100% of the property's current market value of $100,000. I mean, I could even go higher than that. I could pay higher than its current market value because I'm going to force the appreciation and make this property worth a lot more. This kind of offer would be unthinkable for a land flipper who's not going to make any improvements. And by all means, if you're not going to make improvements, then don't go here. Don't offer that much, please. But when you have the option and the ability to make these improvements or subdivide it or get the entitlements, and when you can force the appreciation into these properties that you buy, the margins increase a lot, which gives you a lot more financial muscle you can use when you're making offers. In essence, you'll be working a completely different business model than other land flippers. In fact, I almost wouldn't even call you a land flipper in the conventional sense anymore, because you're going to be offering a lot more, or at least you'll have the ability to offer a lot more, which is going to give you access to deals that pretty much no other land flipper is going to be able to touch. And you'll be pursuing very specific types of land from the outset. So you're only going after properties that you know have development potential. Maybe a property that's really big, where you know subdividing is relatively easy to do, or at least you're willing to do the work to do the more difficult subdivides, or maybe a property where it makes sense to change the zoning or put together some kinds of plans for development. Even if you're not going to do the development, you can at least get those plans put together and approved by the local municipality so that the property is now shovel ready, giving that future buyer, whoever buys it from you, a lot more certainty. And therefore, they're willing to pay a lot more because they don't have to do these things themselves anymore. You did it for them. That's what entitlements is all about. Or just making some improvements like putting up a fence or putting in a driveway or a gravel parking lot or even paving the thing. It just depends on what the property's highest and best use is. But again, if you're willing to do all this stuff and if you're willing to develop certain areas of expertise like this that most land flippers don't even want to think about, it's going to open up a lot more opportunities for you that most land flippers will not have access to. Once again, this is getting into a very different business model of how we make offers. And I've actually got a few different charts that visually portray how these different models look. So be sure to check those out too. But improvements to your properties will completely change the game if you're willing to learn how to do those things. But I'll also say it does take some work. Most land flippers either don't know how to do this work or they're simply not willing to do it. And I'm not even here to tell you that you should be doing this. Okay. A lot of times I don't go after these kinds of deals myself because I don't want to deal with all this extra stuff. So I'm not saying you need to. I'm just saying that if you're willing to take on these added complexities, you can potentially make a lot more money. The people that I know who are making millions a year in the land flipping business are at least open to doing this. They might not do it all the time, but they're willing to learn it and take these projects on when it makes sense for them to do so. And again, I'll be the first to admit that subdividing, entitling, or improving vacant land is definitely more complicated and time-consuming than a simple land flip. But still, if you're willing and able to do this extra work, you can easily offer more than any of your competitors and get deals that nobody else can get. So another thing we need to rethink when we're going after larger deals like this is how we value each lead. When you're looking for larger deals, the marketing process is definitely still a numbers game, but I think you'll likely find that you also don't need to do as many deals to make the same amount of money. I mean, it's just simple math. When you're making a lot more money per deal, you're going to reach your financial goals a lot faster and you don't have to do as many deals to get there. Of course, if you want to make a lot more money in the end, you can keep pushing just as hard on your marketing, but you won't have to. When you start making, 10 times more per deal, you have the luxury of focusing more on quality instead of quantity. And because of the nature of these higher value properties, the value of each lead is also higher. This means when a property owner responds to your marketing campaign in any way, whether that's calling you back or visiting your website and submitting something or responding to a text or email or however you initially reached out to them, if they respond in any affirmative way and say anything other than no, that is a high value lead that's worth your effort to follow up on again and again. Even if they're not ready to sell today, it's worth your while to continue following up with them every month or so just to remind them that your offer is still there. It's still on the table. By contrast, when you work with cheaper properties, this kind of follow-up isn't quite as vital because you can just as well spend the same amount of money exploring new markets. However, higher value properties are a little bit different because each one holds the potential to make much larger profits. Because of this potential behind each deal, it's worth the time and trouble to try to squeeze each one until they tell you to stop contacting them. Now, another thing to be aware of when you start dealing with larger, more valuable properties like this is that when it comes time to sell these things, the whole way that you price them and even the types of buyers that you end up dealing with is very different from when you're dealing with cheaper, lower end properties. In my first few years, when I struggled to buy and sell dozens of cheap lots by myself each year, it seemed like I always had to sell my properties at a huge discount if I wanted them to sell quickly. And part of my problem was that I was working in a slow, depressed market at the time. But another big part of the problem was that I was trying to sell garage sale properties, which naturally attracted shoppers who wanted to pay garage sale prices. And when you start working with larger properties at a higher price, you start dealing with a completely different type of clientele. A lot of these buyers have the money and they can get whatever loans they need to take these larger properties off your hands. Your land is just one part of a much larger picture to them because these buyers often have much larger plans to build houses or developments, and buying the land from you is just the first of many steps that they're planning to take. And I mean, sure, they'll buy it for a discounted price if you advertise it and list it that way, but when you've got a premium property in a growing market, you won't have to. The right buyers will gladly pay the price you want for it. And another really important thing to think about when you start dealing with larger properties is the whole question of capital. If you're anything like most people, you might be asking yourself, where am I going to get the money to buy all these larger deals? I hardly have enough cash to buy smaller properties, and I definitely don't have enough cash to buy a $100,000 property or $200,000 or $300,000 or $500,000. Don't worry. I have great news. You don't need the cash to buy these properties alone. These days, if you have a good property under contract at a good price, it is surprisingly easy to find land funders who will partner with you to complete your deal. And the interesting thing is, back when I started in this business, there were no land funders anywhere. Banks didn't want to touch vacant land, and there definitely weren't any private money or hard money lenders out there that wanted to deal with vacant land either, because none of them understood this business. None of them knew how to value and collateralize land like this. But fast forward several years, a lot more people have gotten into this business, and a lot of these people have tried their hand at being land flippers themselves, and they've seen enough to know that this is a legitimate business model that works and can make a lot of money. And they had the money to contribute to these projects, and these are people that we now call land funders. And if you find a great deal in a great market and you bring it to them, and if they feel comfortable and excited about participating, they'll fund the thing, usually 100% of it. And in return for being your financial partner in the deal and taking on all the financial risk, they're going to expect you to cut them in on a sizable portion of that profit in the end when the property sells. And every land funder is unique in how they structure their partnerships, but if you go into this type of relationship with reasonable expectations, you'll probably find that working with a funder is a far better scenario than trying to do one of these huge deals yourself. In a lot of cases, even if you do have all the cash available to buy it on your own, it still may make sense to use a funder. And like I just mentioned, the downside of working with funders is that most of them will expect a big chunk of the profits that you make on this deal. But from what I've seen, and I've talked to a lot of different funders at this point about how they structure their deals, and all of them arrange it a little bit differently. Not a single one that I've met does it exactly like another one that I've met. But what I can say in terms of consistent themes I've seen among many of them is that most funders, if they're going to fund 100% of your deal, they're going to expect to hold title to that property. So they will be the titled owner, and they will ultimately have most of the control over the deal. And they're going to expect to keep anywhere from 30 to 70% of the profits when the deal is done. And that number can range a lot based on how much the operator, so that might be you, are putting into the deal, if anything, or how much work the operator is doing to make the whole deal happen. And this may sound like a lot of profit to sacrifice, whether it's 30 or 70%, but when you think about it, it's actually not that bad. And here's at least 3 solid reasons why. First of all, your cost of funds in this deal is nothing. Okay, because think about it. When a funder is fronting all of the cash to acquire a property, you don't have any money in the deal at all, which means your cost of funds is 0. This is a huge advantage because when your money isn't tied up in your own inventory, there's technically no financial limit to how many of these deals you can do at a time. If you've ever tried to buy all your properties yourself with your own cash, and I'm guessing most people listening to this probably have, you just can't get that far on your own. At some point, you're going to hit your limit where you can't afford to buy anything else until you sell off some of your inventory and recoup your cash. This is an extremely common bottleneck that every land flipper has to deal with at some point. And when you're working with a funder, your own financial limitations aren't limitations anymore. Even if you have one funder that you prefer to work with, and even if they run out of their own cash to fund your next deal, that's still okay because you can find yet another funder to do the next one. And you may have to relearn some of the rules of how they work, but when you're willing to go down this road and bring funders into the picture, it will open up so many opportunities for you. Now, even though your cost of funds is technically 0, there are still other hidden costs. I mean, say if you did have all the cash and if you could buy a huge deal yourself and keep 100% of the profit, then that's certainly one big trade-off of using funders. I don't mean to say that funders are always the right thing for every situation. And also, you want to look really closely at whatever agreement you sign with a funder because there may be other costs or terms involved that could affect your total cost of using their funds, such as, any fees or late sales or penalties for not achieving certain milestones. So there's a lot of stuff to consider here, but a lot of land investors I know are just adamantly against using funders, or maybe they're not even aware that this is a legitimate option that they can consider on their next deal. And the reason this is worth thinking about is because when you know you have the money, it completely changes your whole thought process about what types of deals you're willing to go after in the first place. I know back when I had no money to my name, whenever I came across a big deal that I just knew was way out of my league, I wouldn't even make an offer on it. Or maybe when I would filter my lists, I would intentionally screen out the bigger properties because I knew I couldn't afford them on my own. But when you know that the money is there and waiting, as long as the deal is right and the market is good, it will rightfully change everything from the very outset of how you start looking for properties in the first place. Another very compelling reason I think it's worth your while to work with funders at some point is because the funder can be a valuable second set of eyes on your deal. And when you're buying bigger properties like this, the quality of your due diligence and the research you do on each property before you buy it becomes exponentially more important. With the tricky nature of land, it is very easy to overlook the finer details. I've done it before. Pretty much every honest land investor I've ever talked to has probably done this before. Very easy mistakes to make. And if there was ever a time to scrutinize a deal carefully and even get another set of eyes to review your property and make sure it's a good deal, these bigger deals are where you want to do that. Now, granted, not all land funders are sophisticated and experienced with land. Some of them just have cash and they're willing to throw it at you. But if you can find a funder who is very proficient with land investing, and several of them are out there, this kind of valuable oversight is exactly what you'll get. And these people aren't just going to gloss over the details like they don't care, because remember, it's actually their money that's going into the deal. So they're going to care about the quality of the due diligence even more than you will, or at least they should care about it more than you will. So that's another huge compelling reason to consider working with funders. And a third very compelling reason is, remember, the funder is taking 100% of the financial risk in this deal, or at least most of the financial risk, depending on how much of the money is coming from them versus you. I mean, think about this nightmare scenario. Suppose you find a property and you can buy it for $200,000, which is no small amount of money. And after all the due diligence, you and the funder agree that you can probably sell the thing for $300,000. So you go ahead, you move forward, you buy the property, and then 1 month after closing, as you start trying to sell this deal, you discover a big issue. There's a building moratorium in place, which means the local municipality is not allowing for anything to be built on this property or anywhere near this property for the next 5 to 10 years. This isn't common, but it does happen from time to time if you're unlucky enough. And because of this, the most this property will ever sell for in the short term is about $100,000. That's about half what you paid for it. Now, I sincerely hope you never experience this, but if you ever did, and if you had a funder involved, and if you both did all of your homework, and neither of you found this problem, and you both agreed to hold each other harmless, at the end of the day, this problem would be far more on the funder's lap than it is on yours, because they're the ones who are most heavily invested in this. And granted, it may depend on what responsibilities are spelled out in your agreement with the funder, and this kind of scenario may or may not damage your relationship with that funder. But still, for most intents and purposes, this catastrophic financial burden would not be on you, because your financial partner, the funder, took on most, if not all, of the risk so that you wouldn't have to. So while at the end of the day, it's completely up to you if you ever want to deal with funders, I wanted to take a minute just to address this, because funders become more and more relevant as you start looking at these bigger and bigger deals. And if there was ever a time to seriously consider it, it's when you start looking at these bigger and bigger deals. Now, let's talk a little bit more about this whole due diligence issue, because as we just discussed, due diligence is always very important with any land deal, but it is huge when you're dealing with these larger properties. And as you transition to higher value properties, thorough due diligence will become more important than ever. When examining the zoning restrictions, the property boundaries, the access issues, potential easements, any potential issues with flood zones, wetlands, perk tests, and on it goes, don't just look at the county maps online and call it good, because in many of the worst situations I've ever heard of, the deal-killing problems that came up after the fact were issues that frankly couldn't be seen just by looking at the online websites that provide this basic information. In order to really drill down and get to the bottom of what's going on or any potential issues, you just need to be ready to pay for professional services. I'm talking about like surveys from licensed surveyors, wetland delineations when necessary, environmental reports when you're dealing with commercial or industrial properties, and anything else you'll need to have absolute certainty about the value and usability of each property before you buy it. And by identifying and addressing potential obstacles early on, you can avoid very costly surprises and ensure a smooth transaction on both sides of the deal. And I'll be the first to tell you, I don't enjoy paying for this kind of due diligence. I remember when I bought my first property that I decided to develop into a self-storage facility, and I had to pay about $12,000, including my closing costs and also just some initial things after I bought it to change the zoning, just to have a fairly educated idea of what I could do with the property. That's $12,000 that I could have spent it and then found out the answer is no. You can't do what you want to do with this property, and that money would have just been gone. And that's a very real scenario that you have to be willing to accept when you start dealing with these higher end properties. And by the way, that's yet another argument for using funders, because they can help out a lot with this heavier financial burden on the higher end deals. But the bottom line is, the more you know about a property before you buy it, including all of its faults, and there are always some faults with every property if you dig deep enough, the better equipped you're going to be to negotiate the best price and close the deal without overpaying. Now, as we get closer to the end of this whole discussion, another huge mindset shift is that you're going to have much more room in your budget to build your dream team. As your deals grow in size and the complexity increases and you start funneling much larger paychecks into your account with each deal, it will become increasingly affordable for you to stop doing everything yourself. This is a huge upside to focusing on bigger deals. Not only will you start making a lot more money for your time, but you'll also be able to pay the great people to come alongside you so you can get much further than you'd ever be able to do on your own. If you're used to routinely going after those teeny tiny deals all the time, you already know it's hard to hire great people, pay for title companies, and give away a chunk of your profit to an agent when you're only making a few $1,000s on each deal. But when you're making tens or even hundreds of thousands of dollars per deal, it is a no-brainer to pay good professionals to carry the ball for you. You can start by partnering with experienced land-specialized agents who can provide invaluable insights on pricing, market trends, and listing strategies. You can also cultivate relationships with title companies and closing agents who can handle any closing you need. You'll also be able to rely on land use consultants and surveyors and attorneys who can help navigate the intricacies of these higher value transactions. Every land investor I know who pursues larger deals like this has pretty much completely outsourced the entire selling arm of their business to land specialized agents. That means half of their business, and arguably the more difficult half, is done by outside professionals who are better and faster at selling vacant land. And this frees up a lot of time for the land investor to find more and better deals. So this is a massive advantage to working with higher end properties. So I hope by now you're seeing the upsides and advantages of going after larger deals and the reason why many land flippers eventually find themselves going in this direction. And to succeed in the world of high value land flipping, it is very important to adopt this new mindset, seeing yourself not as a solo operator anymore who can only afford a few cheap properties at a time, but as a leader of a team of experts. You got to pull together the right professionals and find the money from the right funding sources so you can work together to close deals and generate much larger profits than you'd ever be able to do on your own. You're not working by yourself anymore. You are leading an organization capable of generating mind-boggling profits that could never be achieved alone. As I think you'll see, it's a much better, more profitable, and more sustainable way to run your land investing business over the long term.